Hi and welcome back. This is part three. This is where I go through the expectations, for my macro outlook. So, of course, the Fed pause, a little bit confusing when you looked at the dot plot because it's still predicting two more potential rate hikes this year. Of course, that's just really going to depend on inflation. But there are still other variables in play around inflation, of course. And oil. If we use oil at sort of $70 as a benchmark for one of the metrics, if you see that oil price start to spike up, you've got to expect inflation to be impacted by that. So, that's just a sort of a base to start at. If it's below 70, again, you could start to consider that inflation will drop, gasoline prices drop, etc., etc., until, of course, we start to move towards the winter months again, and then we'll have to wait and see because that could be very interesting. Although, the majority that need sort of nat gas and all that would have already been loading up, and of course, with such a mild winter last year, it won't take so much to fill those ready for next winter. Now, another area is used cars and autos in general, the used and the new ones, and also shelter, sort of rent, mortgages, etc., etc. And then another one, which is sort of pretty obvious to monitor, I would say, would be food prices. And they could start to increase again just due to El Nino becoming very active. Now, you probably don't know much about this unless you're trading commodities, but this is a weather front that sort of is sort of created in I think it's the Pacific. And then it really sort of can turn the weather extreme. We saw a lot of that last year, but it's likely to do it again this year. You get those sort of extreme weather conditions, and that again can have an impact on commodity prices. And then, while we stick with, what's impacting inflation and what's going on around the world, geopolitically, we've still got OPEC plus, if they feel that oil prices aren't going up and demand's going to drop, they may sort of cut again. They're trying to sort of catch the markets off guard at the moment, but with very, very little success. And then, of course, we've got the Russia-Ukraine conflict still going on. And then China adding more stimulus. So just keep an eye on that, because obviously if China adds a lot of stimulus, again, that can become inflationary. If Russia-Ukraine sort of flares up to dramatically, then again, that can impact commodity prices. Now, although the Fed didn't hike, it could still feel in the US sort of economically as if they have. Bank lenders are sort of less willing, that they've tightened lending conditions, and again, sort of that is going to sort of feel as though it's another rate hike, because it's not going to be so easy to access money. And then, of course, you've got that massive issuance coming from Yellen. The Treasury has already started this, and it's likely to issue between $500 billion and $1 trillion worth of various treasuries. And they're going to try and do that, I would say, before the liquidity dries up over the summer. Again, always remember, this is just my opinion. Now, the ECB hiked by 25 basis points with another one expected at the next meeting. To me, I just think, why don't they just do a 50 basis point now and get it done? And then just have a break, the same as what the Fed's done. So, why warn of another 25 pretty much all guaranteed? Why not just have got 50 out of the way? Okay, you might have spooked the markets, but that could have been a good thing. And then, of course, we've got the Bank of England this week, and they will also hike probably 25 basis points. If inflation is still really high in the UK against its peers, and as I mentioned in part one, it does get a bit sticky in the UK once it starts to move. You know, historically we've had some very problematic issues with inflation, and you know they could be around the corner again. Which, to a degree, to me, just thinks, well, you know, why is cable almost back to 130 against the dollar? It just doesn't make sense. Right, so as I mentioned before, the UK does tend to hold on to that inflation once it starts. And of course, Brexit would have sort of exacerbated that situation. And of course, to me as well, it's that corporate greed that's still there. And you know, all of this is just going to make it seem as though, you know, that these rate strategies are diverging. But for me, in reality, it's just, you know, the US were more aggressive it sort of last year. And that all that is just Europe and the UK just simply playing catch up. As I mentioned, the dollar suffered again last week. I just have to go against this sentiment. They've still got the strongest economy. You know, there's tens of trillions of dollars floating around that system. And of course, with stocks so high, US households are sitting on $147 trillion in equity. And they've still got 30 trillion above pre-COVID levels. Now, Powell did comment, and you know, I've been warning of this for some time, that rates will stay higher for longer, possibly years, he mentioned. And that's before they drop. But of course, you know, I get that, and you know, it has to be accepted that these low zero rate situations are just purely for a crisis. It's not to provide us with cheap money. And of course, you know, if money does become cheap, that again becomes inflationary. When we look at the ongoing war between Ukraine and Russia, you know, Ukraine is sort of got a counter-offensive going on again, and they are pushing the war right into sort of the Russian forces that are in Ukraine. And Putin's responded by parking some nukes, some nuclear weapons on the EU borders. Now, for me, recession risks do still sort of remain, especially in Europe and the UK, other parts of the world as well. You know, okay, Europe sort of entered a technical one already, and then of course we've got New Zealand that's just entered one as well. And of course, you know, if rates continue to hike, this is going to sort of push these economies into recession. You know, the big question then is, are they going to be shallow or deep, short or long? And you know, we're going to have to wait a bit longer to find all that out, obviously. Now, protectionism still seems to be with us in many countries. You know, the countries are aiming to produce their own goods, especially around semiconductors. You know, domestically they would rather do that to just remove that risk of another shortage in the future, which is understandable because, you know, they're in so many different products these days. And there does remain a sort of a high level of investment in that sector, both from governments and also corporates. You know, even funds and all that are investing in that area. And not just there, because, you know, some EU countries seem to be handing out grants and aid, not only in that sector, the semiconductor sector, but indeed anything that's actually sort of green related. So just go back to the jobs market for the moment, and you know, that does remain tight. Okay, I'm a little bit surprised by that. And you know, I do expect this to change considerably by the end of this year. You know, we're already seeing initial jobless claims rising in the US, so maybe this is a pattern that's going to be built on. And with summer fast approaching, it seems that, you know, the economic outlook does just remain that little bit sort of blurred. And so, yeah, so that's pretty much it for the macro at the moment. And then in part 4, we're going to look at how the technicals can help us for clues for going forward. So I hope to see you in that part. As usual, before we move on to part 4, Just to highlight again, we offer sort of daily newsletters direct to your inbox, which include global news and my views. Also available are daily chart levels, with including pivot points. And then we offer in the way of services to help you improve or get into trading, 1-day workshops, 1-week courses, and of course our comprehensive accredited masterclass, which starts this Monday the 19th. That is designed to provide you with all the knowledge and trading tools required to navigate any market and in any conditions, and of course any asset class. If you're looking to improve, then we offer mentoring services. If you're a company and you have exposure to FX and or commodities, we can help you. And of course we provide a lot of trader education and content to individuals, exchanges and brokers. If you don't want to use your capital or you haven't got the capital to use, then consider getting a funded trading account. Of course you have to qualify for that by going through the challenge. Now you can contact us at info@cymaxfintech.com with any questions about the post that we add on here or of course our services. And if you want to reach out to me, it's chris.tubby@cymax-int.com. And now we're going to move on to the final part, which is where I do some analysis.